Hello, my name's Alison Trant. I'm a director in the debt advisory team here at PKF Francis Clark. I'm going to take you through this session where we're going to have a look at the interest rate outlook, followed by sharing some examples of what we're seeing in the current funding marketplace. And then I'm going to do a bit of a deeper dive into working capital and some of our advice and guidance on that. So without further ado, straight on to the current outlook for interest rates. This particular graph is showing us the 3-month SONIA rates. SONIA rates typically track closely to Bank of England base rate. And just a technicality, this particular graph was extracted on the 7th of October. At time of speaking, the budget has taken place. The feedback from the budget immediately is there's some expectation that rates, perhaps the reductions will be a bit slower than was anticipated pre-budget. But the overarching message from that and from looking at this graph is that very much the outlook remains a downward trajectory. We're basically expecting throughout 2025 continued reductions in base rate, heading towards about 3.5, maybe even as low as 3 over the next 4 to 5 years. So good news for borrowers. Turning to the current funding marketplace and what we are seeing from our work with clients from PKF, the high street banks are very much open. We have seen over the last years in post-COVID, they had to deploy lots of COVID recovery loans in the form of C bills and B bills, and that saturated the bank's balance sheets. Those loans are being steadily repaid, and that is freeing up the bank's balance sheet to return to normal lending business, and that's very welcome. The alternative funding market, and just as a recap what we mean by the alternative funding market, very quick summary, it's essentially any lenders other than the high street banks, but that includes a plethora of lenders. So the challenger banks such as Metro Bank, not Santander, Aldermore, Shawbrook, etc. We've also got in there some specialist lenders like Secure Trust, Bibby, Navuna, Funding Circle, and then we've got the debt funds that some of you may have heard of, such as Thin Caps and Triple Point. So that catch-all term, the alternative funding market, does cover a wide range of lenders, but the general feeling from that marketplace is they have significant capital to deploy. They are, like the banks, are very much open for business and actively seeking lending opportunities. So this again is good news for borrowers. You should be able to find yourself with a number of options available. And turning to those options, then the pricing versus structure considerations, and this is something we want to share with you. Quite often the focus when you're looking to borrow money is just to seek out the lowest possible margin, and whilst those possible margins for borrowing are always welcome, there are some other things to take into consideration, and this is where perhaps the alternative finance market plays its role. For example, they will tend to charge a higher margin than the high street banks, but they'll take a less conservative view of the lending request. And what do I mean by less conservative? Well, I mean, for example, they will typically have appetite for higher leverage multiples. A high street bank might be comfortably in the 2, maybe to 2.5 times. The alternative funding market will actively consider 3 to 3.5 times leverage multiple. Obviously, always subject to debt service capability, but in terms of the structure flexibility they can offer, that's taken into account. They will consider higher loan to values in property transactions, for example. They will look at business propositions that are in earlier stage growth. A high street bank might typically prefer something more established, track record. The alternatives will consider that earlier stage. They will also have greater appetite for longer interest-only periods and what we refer to as bullet restructures, and that simply means that you're leaving a proportion of the debt left at the end to be refinanced. A high street bank would be typically more at the end of seeking all their borrowing to be repaid fully over the agreed tenure of the loan. As I say, alternative finance will just have more flexible points of view on how to structure the borrowing. So there is a price premium perhaps, but much greater flexibility on the structure. So these are the things we think are worth considering. Turning to the actual margins that we're seeing so far this year, we're typically seeing the high street banks returning back towards the low twos again, which is very welcome. I've actually just had a deal for 1.8% margin on a 5-year interest-only loan. That's the first time I've seen below 2 this year. High streets between 2 to 4% margins are typical. Moving into sort of challenger bank space, we would typically see between 3 to 6% borrowing margins. So just to recap that price, you are seeing a premium, but in return for that, they will push those loan to value boundaries. They will offer longer interest only periods. So it's a price in return for what's deemed to be a slightly higher risk. And then the debt funds who will do like the higher leveraged transactions, for example, we are typically seeing somewhere between anywhere between as low as 8, but more on average 10 to 12%. But that's an all-in rate. That's a total cost of borrowing. As I say, because of the structures that they're able to offer, whilst the margin might on paper be higher, the structure means in real cash terms, there's less cash flow out for the business in terms of affordability. Just making a connection back to that outlook there for the interest rates that we looked at in the slide previous, that trajectory is downward. We are expecting reductions, and therefore current fixed rates on offer are quite often lower than the current variable rate that you can offer. So if you are looking to take out some new borrowing, it's worth considering what fixed rates are on offer for all or even a portion of the debt that you're looking to take on. When we're talking about the funding marketplace, I thought it's always helpful to share some real examples of the ways of some of the transactions that we've worked on. And so these are 3 deals that we have worked with PKF clients so far this year. First example is asset-based lending. This deal is being executed by one of those specialist asset-based lenders. And this is a client that currently has over £20 million of debt across hire purchase agreements from 16 different lenders. When you're reflecting that, it sounds, well, how did you find yourself in that position? Lots of businesses do, because HB is typically taken sort of on an asset by asset basis. And what's happened here in this particular business, you eventually do reach a scale and a size that you reach a tipping point where you don't need it becomes inefficient to be arranging the finance per asset or per chunk of assets each and every time, and you end up with this long tail of 16 different lenders that you've got agreements with and outstanding, and having to manage and renew all the time. So this has absolutely reached the tipping point where what we are doing here is one lender is going to refinance all of that debt. They're also providing some additional headroom against the assets in this business growth and to release some cash for growth. What that means for the client, there's 2 important outcomes of this exercise. Really importantly, they have managed to reduce the borrowing margins, that the variety of interest margins that were being charged across all the different agreements in place. There was quite a range. This one new larger facility is more cost effective. It's also revolving in nature, and this is an important point. The traditional HP agreements have a repayment term of 3 to 5 years, or depending on the life of the asset in question. This is a revolving, so it's a committed facility for a 3-year period, and it will just renew as long as a certain defined level of assets remain on the balance sheet of the business. Then that facility will just continue to be available. That is a significant impact on the cash flow of the business, not having to make capital repayments over relatively short periods of time, freeing up yet even more cash for growth. And then finally, just operationally, the client gets to deal with one lender, not having to manage 16 different renewals and points of contact, etc. So just operationally, that's just going to be significantly easier and more sophisticated way for the business to conduct its funding going forward. Second example we thought worth sharing, because I think quite often there's a misconception that to raise finance for the purpose of taking cash out of a business is perhaps not possible or very modest. In this particular example, the investors had acquired this business from administration 5 years using their own resources, and we have just obtained an agreement for we're calling it a 3+2, that's an accordion is the official term, but £5 million worth of funding, £3 million which is available immediate, and a further 2 subject to continued performance parameters. But that fund, it was entirely for the purpose of cash out to the original investors. Not something particularly, maybe a high street bank might support it, but modestly, I would say this is allowing quite a significant amount of capital to be returned to the original investors and allowing into there an all-in rate of 11% for that form of funding. Third example, it relates to commercial property. A client of the firm which is currently renting their premises and had simply just ruled out the prospect of owning the freehold because they didn't think it was possible. They didn't think they were going to be able to raise sufficient capital towards a deposit, nor did they had a conception that the repayments on a mortgage would be significantly higher than they're currently paying in their rental payments. The outcome of doing a review was that was not the case, and they've subsequently gone on to purchase a freehold property. The alternative finance market were able to offer a high loan to value, 80% in this particular example. So the client was able to raise sufficient cash towards the deposit. And furthermore, they did a 5-year interest only period and overall a 30-year term. That has meant that the repayments were entirely affordable and in fact less than they are currently paying in rent. So the key message is just perhaps explore options, and by all means you will have your main high street bank contacts and it should be discussed with them. But this is just to remind you that there is a wider funding marketplace out there that can present options, albeit maybe with a higher margin, but with terms that might be more appealing overall. You will very rarely have a conversation with the banker and they won't not say these terms. Cash is king and cash flow is queen, absolutely fundamental in every business. And so we are going to spend some time actually delving into some of the ways in which we can support, or some of the methods and products we're seeing on the marketplace currently which assist with working capital, and just also some general advice and guidance around working capital, because it truly is the most fundamental aspect within the business. I thought we'd start by just discussing overdrafts. Where have they gone? The current capital adequacy rules that are applied to banks, which is very important following the banking crisis, it does mean for the main banks that overdrafts are essentially, if they're not used, are essentially very inefficient use of their capital. Because if you have an overdraft on your account, the bank is required to set aside the capital for its use. And if you're not borrowing on it, they aren't charging their interest margin on it. And the reality is they could deploy that capital elsewhere for another purpose for a better return. So they're not efficient use of capital for banks, and therefore we have seen a marked reduction in the provision and desire to provide overdrafts over the last 10 years. They can still be available, but to say there's just, compared to say pre-banking crisis when it was the absolute go-to for working capital, that is no longer the case. So what do you do instead? And there are thankfully a number of other working capital tools available to businesses. We thought it worth mentioning trade facilities. It is worth exploring if you are importing and exporting, that you are maximising all possible trade finance facilities available to you, and that should be a conversation with your high street bank on that subject matter. It's also worth noting there are some boutique trade finance providers who will simply just put a facility alongside any of your existing banking relationships, which will extend your working capital payment terms. So it's just a call out on trade facilities. I won't delve into the actual specifics of all the different products because there are many, but if you are importing and exporting, please spend some time, get in touch with us to conduct an exercise to make sure you are aware and using, where applicable, all possible trade facilities available to you. Invoice discounting. For those of you that already invoice discount, the general advice on this is to conduct reviews. We see long-standing invoice discounting facilities that are with the same provider for a number of years, and if it isn't broke, don't fix it. That may and well truly be the case. But it's worth conducting an active review of the invoice finance facility, because what we do see in practice is, for example, a business will have a prepayment discount percentage of 85% on paper. In real terms, when the exclusions and credit limits, for example, are applied, the actual discount being applied to their debtor book is maybe near 60%, for example. So it's just calling out that you'll have a set of terms which discloses what your discount percentage, maybe 85, maybe even as high as 90%. But the real test is to work out what your real percentage, what are you actually getting against your debtor book on a monthly basis. And if that's a lower number than you were expecting, then that's a sure sign to conduct a review and explore the marketplace for what other funders' terms could provide. They will have different views on credit limits, they will have different views on exclusions, etc. They will just have different appetite for different sectors. So, and it's conduct a full, I would conduct a full review of different options available to you when your renewal period arises. Staying on the subject matter of invoice finance, selective invoice finance does exactly what it says in the tin, as opposed to full invoice discounting, which basically funds your entire debtor book. Selective invoice finance enables you the ability just to pluck off one or two debtors and raise a specific amount of funding against them. A very helpful tool for businesses, and we think it's exceedingly helpful to roll out. It's very easy to put in place. You're just literally paying for the debtor that you're funding against, as opposed to the full-blown invoice finance facility, which might not be suitable for your business. So again, if anything that we've said here triggers you think that might be useful, please get in touch. And moving on to the next working capital tool, this is a recap of the example that I've just previously been through, asset-based lending. If you're a business that has a strong balance sheet, a number of assets on your balance sheet, property, stock, debtors, for example, the asset-based lending marketplace continues to evolve and become more sophisticated. And as per the previous example, we are seeing solutions being put in place where essentially you use the assets on your balance sheet as a funding base, and that allows a revolving facility to be structured against those assets. And the revolving nature of the facility without any actual fixed repayment means is a significant enhancement to cash flow. Moving on, another tool that we see quite effectively, and an effective use of charge card programs for payment terms. The NHS, I've funded a number of hospitals over the years, and the NHS operates this system. Essentially, a charge card will provide a business with 45 days of interest-free credit. So the balance is cleared basically at the end of every month, and will afford you, or at the end of the 45-day period, and that will be entirely interest-free. So it can be quite a simple but highly effective way to just extend credit terms on an interest-free basis. card programs now are so sophisticated in terms of the software that supports the operation of them. They can be fully integrated into whatever accounting package you are using within your business. The reporting systems are excellent. So again, just something, if you've not introduced it or considered it or thought about it, something to think about. An additional benefit of using cards as payment mechanisms is quite a lot of the card programs and card providers offer cashback on spend, and it's generally tiered. So the more spend that's put through the card, the higher the reward. So again, just another reason to consider this source. And then just I thought worth talking on another working capital solution you might not have come across is if you are involved in foreign exchange in your business. There are providers, your current provider may do this, but if they aren't, then something to think about. There are providers that will offer forward contracts on foreign exchange that doesn't require any deposit. Again, that could be a significant cash flow saving depending on the volumes that you're putting through. The overarching message from this session is basically to review your working capital, have this discussion with your bank to make sure the high street banks are constantly bringing out new products and developing them. So have that conversation with your point of contact at your bank to make sure you are aware of their latest offerings in this regard and whether it's appropriate and helpful to your business. And also, if you do want to explore what's available in the alternative funding market, that's where myself and my colleague Jeremy here are help you to undertake that. The final thought that I just wanted to leave you with today, this has been a strong sentiment from throughout this year, I think across lots of sectors and lots of businesses, but I'm obviously speaking in this particular circumstance with regards to raising finance. Everything is taking a lot longer than perhaps we would like, but more importantly than we would expect. So the message here and advice here is simply, if you are thinking or considering any funding, to begin your conversations or your research or investigations as early as possible. There are lots of options available, and in order to get the best possible outcomes from the exercise, we need to allow as much time as possible. Hope this has been helpful. Thank you for listening.